episode 149 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risk and seize opportunities. Learn more at futuresfundamentals.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudelli sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudelli.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we get started, I want to thank all of our sponsors, CME Group, Trading Technologies, and Top Step Trader. So without further ado, let's dial into those top moments of the show this month. And a lot of people have been telling me that they're going to be using artificial intelligence alongside with or somehow working with algorithmic trading. What do you think about AI? And also talk to us about how you think that will impact algorithmic trading.
Artificial intelligence is a really interesting space, and there are some very, very bright minds, much brighter than mine, that are working on it. With my limited experience, I'm sure, as you know and as your audience knows, it's broadly classified into two categories. There's the general AI, and then there's more specific task AI. And the general AI is kind of what people think of when they think of the Terminator movies and, you know, these cyborgs trying to take over the world and kill everyone. So then there's the other AI, which is much more, how to drive a car or very, very specific small task sets that can be done very efficiently. And those two categories are vastly different. And to really be good in the markets, I think you need a much more general approach. So the general AI side is, I'd say, 10 or 20 years away. And so before AI really takes over the markets, it'll probably be 10 or 20 years. But in the meantime, we've got a lot of strategies and algorithms which have very specific tasks that AI is great for. So often it's like JP Morgan just came out with one, I believe, that was doing algorithmic execution with artificial intelligence. So it's a very specific task. You have $1 billion worth of shares that you need to execute in the market, and you need to monitor the best possible times to execute those and look at the market participants, look at the prices, look at whatever input data streams you want to try and figure out that optimal time. But that AI would be useless at driving a car. It would be useless at reading a Twitter stream. Like, it's very, very specific, and it's got very specific use cases. And so in the next sort of 2 to 5 years, I think those specific task AIs are going to proliferate. We're going to see them everywhere. People are going to, even in our community, we see people writing a lot of different strategies using task AIs for specific things.
I mean, it's definitely an interesting time, to say the least. And speaking of interesting times, we have a pretty interesting president right now, President Trump, and he talks a lot about deregulation. It's funny, if you watch the media, all they talk about is healthcare possibilities and possibilities of tax cuts. But if you really see what's happening, he's doing a lot of deregulation. And this is something that he's actually been able to achieve on, and I think that's really, in my opinion, a big driver of sentiment right now, I think, in the market. And the reason I even mention that is because right now we're seeing a change in the Fed. Trump is nominating Randall Quarles as Daniel Tarullo's successor at the Fed. And I've been seeing some positive talk about this, and I'm wondering what this is going to mean possibly for future regulations or deregulations. I also would like to know what your thoughts are of Randall Quarles, because this is a big topic right now. And what do you think it means for the Fed going forward?
Well, it's interesting you bring that up. In the most recent small business confidence survey, the number was unexpectedly higher than what was anticipated. And it came down to small businesses remarking on the fact that the removal of onerous regulations have started to trickle through. into their ability to conduct business. And that's very encouraging, given the fact that, as you say, our new president has not been able to pass any types of sweeping legislation. So I am heartened by the possibility of Quarles coming in and removing some of the more onerous regulations that have actually introduced a higher degree of risk to the financial markets. I'll give you one example, Anthony, and that would be the bond market and bond market liquidity. When you combine the unintended consequences of Dodd-Frank and Basel III, we've seen a literal crash in terms of the inventories that broker-dealers hold of, you name it, credit instrument, whether it's a corporate bond, whether it's a commercial mortgage-backed security, an asset-backed security, regardless of the type of credit instrument we're talking about, because of the penalty imposed by Dodd-Frank, broker-dealers have stepped back from this role that they've typically played, a role that I would add acts as a buffer and a cushion during times of stress, because they're able to step up and provide liquidity when others will not.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. So I want to talk about some of the things that you talk about in your posts, and I really enjoy them because it's a different way of looking at the market than I do. I am primarily a technician. I do some fundamentals, but over the years, charts have been where I get my answers. You say that using data can give you an edge, and using data is what you're doing as a quant analyst, and you're doing R&D for an HFT firm. Talk to us about using data for an edge, what data you're abstracting, and how you believe it can give us an edge.
So I think, like from where we both agree before we deviate in our approach, is that you need to kind of quantify or systematize whatever it is you're doing. So that way you can at least have like an objective way of saying, yes, this is working, or no, this is not. I mean, if you're like, I know when I started, I was jumping around chasing this type of strategy or that strategy or this indicator or this market or this asset class. And I couldn't compare my results because everything I was doing was so different. So I could never really say, yes, this was working, or no, this wasn't. So I took this job as a trading assistant, obviously, and I'm around all of these quants. And now, like, everything I do is this piece of information, this new piece of data, is it changing my view, or is it not? Is it helping me or hurting me? And I think like this whole fear of like data mining or whatever it is, I think it's kind of misfound in a sense, because I think everybody embarks on data mining in one way or the other. I just think the people that use computers kind of do it wrong, or get the short end of the stick, rather. I mean, because, for example, what I was used to doing is I would find a chart pattern or some indicator I liked, and I would look at the last couple examples, and I would say, okay, when this happens, then I should be buying, and when this happens, I should be selling. And then maybe like I would try that out and it doesn't work. Then I change the indicator a little bit, or I change the settings on the indicator, or change the market, and it works. And essentially that is data mining. You just constantly, it's almost like human curve fitting. Whatever the recent data or the indicator is, you're just kind of adapting your approach to what has worked in the past.
I actually started to trade before I really played poker, which is, I think probably majority of people, it's the other way, but I started in this business really young, and I'm still really not a poker player. I really don't play cards that much, but I'm interested in the skill set. And I'm wondering if you felt your poker skills and maybe some of your gaming skills were transferable to trading.
Mm-hmm. Okay, so firstly, my gaming skills were very applicable to poker because fast decision making mostly. So if you play live poker, if you play in a casino, you play maybe 30 hands an hour. So you have a lot of time to think. Okay, sometimes they put you on the clock, so you only have 2 minutes to think, but it's a lot of time. When you play online poker, however, your edge is much smaller. So to basically to still make the same hourly rate on online poker, then you have to play more tables. So you can simultaneously play up to 24 tables. And I couldn't do 24. I was playing 9 to 18 tables most of the time, depending on how soft the games were. So I had like 3 monitors with 18 tables open, and I needed quick decision making because I was playing like 1,000 hands an hour or so. So that helped me a lot from the video game times. And poker itself taught me, of course, how to properly manage my bankroll, how to size my bets, very important. A concept I still use today in trading is if I have better setups, I bet more on it. If I have worse setups, I bet less on them. And tilt was another huge factor sometimes. Like when I started playing, I couldn't sleep for a night because I lost $500 or something like that. And I would get mad at other people. I was the worst tilt machine of all times. So basically, the game theory I had perfect, but my psychology was a huge problem. And during my whole poker career, I read every book on psychology I could find, and worked with some mental coaches as well. And that helped me a lot in trading later, because when I transitioned to trading, I never had any emotions about anything. Like I put on the trade and that's it. I never have any emotions in trading. And one of the reasons why I always tilted in poker, I found out later, was that I get angry at people, but I never get angry at the market.
So talk to us about the process of a customer coming into the Russell. How does a company get listed on your index?
Yeah, that's a great question. And so we'll simplify and we'll talk about the Russell 3000. So the Russell 3000 is comprised of the Russell 1000 and the Russell 2000. So 1 plus 2 equals 3. The Russell 1000 are the large cap U.S. equity stocks, and the Russell 2000 are the next 2,000 stocks below those, and we consider that our small cap series. And the process for coming into the index, there's a whole list of rules. It's very much a rules-based process. So we don't decide by committee who's in and who's out. It's very rules-based. So you have to be listed on one of the major exchanges in the U.S. You have to trade above $1. There's float requirements and a whole host of requirements that come into the index. So once you meet that threshold, then Russell, again, going back to our rules, will determine if you're a large cap U.S. equity stock or a small cap U.S. equity stock. So a company might come in at, somewhere in the Russell 2000 as they're small and growing. And the Russell 2000 stocks are really important in the U.S. because those are some of the fastest, most dynamic companies in the U.S. And oftentimes they're the real engine for job growth and innovation in the U.S. equity space. So a company might come in, in a Russell 2000 small cap stock, but the next time we reconstitute the index, which is the last Friday of every June, you see these companies move around. So you might see a company where a whole series of companies graduate, if you will, from the Russell 2000 up into the Russell 1000. And then we will change the membership of our indexes to reflect the dynamic nature of the equity markets and more accurately reflect where those stocks are within that equity series. And so we do that for large cap and small cap, and we also do that for value and growth. So it's a multifaceted index story.
Speaking of reading some tea leaves, you have some strong feelings on market overvaluations. I've watched you tweet about this a lot lately, and you say that there's some metrics that are showing that we're at least 2 times overvalued, and you said that there could be a 60 to 70 percent correction that could last, you said, it could last almost 3 decades. So talk to us about your market overvaluations, the metrics, and why you think a 60 to 70% correction could be upon us.
Well, so first, I'm presuming that a futures trading show probably has a pretty sophisticated audience, and this is probably not Joe Sixpack as much as traders. First, you have to dispel the notion of PE ratio, and besides the fact that the E is cooked and beyond comprehension, there's been recent activity in the blogosphere about how PE ratios of indices are calculated. A guy named Bregman, I think it is, and being promoted by Jesse Felder, who's been one of your guests actually. The PE ratio of some index will come in, I think it was the NASDAQ or maybe the triple Q actually, came in at a PE ratio of 23, and Bregman tears it apart and says, here's how you get to 23. First and foremost, any PE ratio above 40 gets rounded down to 40. Any PE ratio that's any earnings that are negative gets converted to a PE ratio of 40. So in the scientific world, if you did stuff like this, you would be charged with fraud and you would never get another grant or paper published again. But somehow these indices, and so he calculates, says if you do a real PE ratio of the triple Q, you take all the earnings and losses and you take the market cap and you calculate the PE, it's more like he came out to 87.5 just to keep the sig fig count way up. So that's a real problem because most sort of amateurs like me use PE ratio. I like the others. I like Tobin's Q. Doug Short has a composite that's very good. The Hussman one, which I really love, but I can't say I even understand it, but the correlations are great. Price to GDP. I tend to follow Tobin's Q because it's simple. It's basically price to book value, I think. I got put on that as the go-to valuation model by Mark Spitznagel, who I should add is an interesting character to say the least. And they all put the market at 50% overvalued. And I'll tell you, I don't need to know a lot of math to know that if you are regressing, you can't just regress to the mean because it won't be the mean. And so we spent half the time above the mean and half the time below, and we've been hovering way above it for way too long, and we've got some mean regressing to be done in front of us. And so yeah, I think regression to the mean is 50%. I think regression through the mean and, bargain basement shopping using that cash my dad convinced me to have, 70% maybe. And when, I don't know. The difference between you and I, you said you're not going to fight the primary trend. Once we're overvalued at that level, I just push away from the table.
Absolutely. I'll give you to like a current day situation for me as I've been learning how to play golf over the past, I would say about 8 years. And when I go onto the range and I practice and I practice and I hit balls, or I go out and I play 9 holes by myself, I play golf usually pretty well. Then I play on the Friday game or the Tuesday game, or guys that I'll meet them up on the weekend and play. All of a sudden, you're at that tee. There's a different pressure. And all of a sudden now, at that moment, everything that you've learned, I look at it as, let's compare it to like a simulator. You're just trading and you're just doing things on a simulator, and you're not really concerned with anything because no one's watching and there's no money involved. When you go to the tee, when you're actually ready to trade live, all of a sudden, everything becomes magnified. This is why I say people that use simulators for too long and they don't feel the live action, I think it kind of does a little bit of an injustice for them, because what happens is that once you feel the live action, I believe that by trading with a little bit of money, you start to feel those those emotions, those nerves, and then you fix your mistakes as they're happening. You don't, because for me, the biggest reasons I was blowing up my accounts at the earlier stages was my risk management was poor, but it was really because I wasn't making the decision to walk away at the right time. So I was mentally weak in those instances, and I would just kick the can down the road. When I started to get more firm in my decisions to say, okay, I'm walking away now, or I'm done right now, when I started to make the fixes at the moment, was when I started to feel like, okay, I felt more confident in my game. So that was another thing I wanted to add.
Yeah, very true. I 100% agree with you.
The next thing I'd like to dive in and talk about is discretionary trading, and why a lot of people think that discretionary trading is dead. I don't ever think it will be dead. I think that there's this thought out there that people are thinking that discretionary trading at some point will not exist. So I totally disagree with that. I think that there's always a part for it, place for it in the industry, because I think that the human brain has the ability to do some things that a computer will never be able to do. Maybe I'll be proven wrong down the road. I don't know. But my thought is that the way that I have learned how to trade, the way that I believe that my brain works, and I've tried to do a lot of programming and different things, they have helped me with my trading, some of the programs and things that I have built, but it still can't think or see things, the patterns that I do. The computer cannot. So I believe that it's here to stay. I think it'll be a matter of ebbs and flows. And just talking about ebbs and flows, because I know we're going to talk a little bit more about discretionary trading as well, because I'm going to see what you think about that. But I want to talk about along the way from when you started in your career to now. One thing I want to talk about is I know that you've probably had to adapt. We all have. Has your foundation stayed the same? And the reason why I mentioned that alongside with discretionary trading is because for me, my discretionary trading has changed. I went from trading a lot of contracts in a very short period of time to then trading less contracts now on a medium time period. So although I am still discretionary, it has changed, but my foundation has not. So thoughts about your foundation along your journey, along your career, and talk to us about how you feel about discretionary trading now and going forward.
Yeah, so my foundation is very much still the same. You absolutely have to adapt, and for sure there are things that you could do 5 or 10 years ago that you cannot do now. It's just the way it is. But to me, that's just the way markets are. Like markets have changed over since they've been around, and they will continue to change. We've gone from the pit to the screen. Then we had the advent of kind of the whole algo quant strategy thing, both for on the proprietary side and the execution side, VWAP and TWAP execution algos. Back in the 80s, you had portfolio insurance that was kind of screamed about around the 87 crash. You have new markets coming about. Like I know that you were one of the very first guys to trade the SPOOs when it first came out. Now you've got all these cryptocurrency markets that are in vogue, all that kind of stuff. Even the high frequency players have had to change. I know of a couple of guys at a high frequency shop that were trading. The average trade was 7 milliseconds. Now it's out to between 7 and 17 seconds, because they just can't compete, because that industry has also shifted, right? So I think it's important to find part of your discovery process as a trader is finding what that foundation is, right? So figuring out, okay, what resonates with me, what makes sense to me as a trader, getting comfortable with that, refining that over the years, keeping that as your foundation, and then trying to tweak and adapt as the markets change. And that may be changing markets itself. I don't like the way that the notes are trading, but if I look at the Bund, that seems to suit my trade a lot better, and doing that. You may have to make sacrifices in terms of time zones. I know guys that used to trade the Aussie day session that now exclusively trade our night session. So they've now trading the overnight markets because that suits their style more, because they found that they couldn't compete during the day session. There's so many different ways you can do it. And as a trader, you just have to accept the fact that I'm essentially going to be relearning trading my entire life.
I think that our listeners need to understand what this bond issuance gap is. So if you can please explain that. And also a question we get on this show, and I think it's very important for traders and investors to understand, is the difference between these classic and ultra treasuries and bonds. I know that we have a 10-year, classic 10-year, and then we have the ultra 10-year, and then we have the classic 30-year, and then we have the ultra 30-year. So if you could also explain the difference between the two of those.
Sure, Anthony. Those are great questions. If I may break them into two parts. The first one, you asked about what this treasury bond gap is. So that has to do with the bonds that are underlying deliverable instruments in all of our treasury futures. As you know, the U.S. government issues bills, notes, and treasury bonds, bonds being the term used for the 30-year issuance by the U.S. government. This issuance is done to finance the operations of the government as well as to refinance maturing government debt. When there is a greater need for money by the government, for example, if they are running deficits, the issuance rises, and when there are surplus, which were last seen in the late 90s, the issuance need reduces. And that's really what led to the 5-year gap. Our listeners may recall that the U.S. was running budget surpluses, which led to pay down of the debt, such that not all maturing debt needed to be refinanced. As a matter of managing its debt optimally, the U.S. Treasury in 2001 suspended the issuance of the 30-year bond. That suspension lasted until 2006, since when the 30-year bond is being reissued. So that really led to the so-called 5-year gap on the Treasury bond curve. There are no bonds that mature 30 years from that 01 to 06 period.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.